Look at what just happened in the United States. The Federal Reserve cut rates on September 17th to a target range of 4 to 4.25%. Then it cut again on October 29th. That is a pivot, while inflation still sits above target. The signal appeared in that sequence, not in a headline. Watch the timing. Rate cuts arrived as unemployment edged higher and real yields, the interest rate minus inflation, stayed positive near 1.8%. That mix doesn't appear in a boom. It appears when the system protects jobs first and tolerates slower disinflation. The last time policy eased into rising real yields, recession risks rose. The mechanism works like this. Cheap pandemic debt carried low coupon. The fixed interest rate on a bond, that paper matures into mid-decade. It must roll. Refinance old debt with new debt at higher rates. Every trillion rolled at double the coupon lifts interest costs. The math doesn't care about optimism. Now the pressure builds. The Treasury just kept coupon auction sizes steady into November while bills flex. 3-year supply near 58 billion, 10-year near 42, 30-year near 25. All settling mid-month. That is supply meeting buyers who now demand term premium, extra yield for holding long bonds. Translation: the government must pay more to borrow. Picture this for a second. The government's interest bill grows while the economy slows. It's like paying a larger credit card minimum while hours at work get cut. Check this contradiction. Stocks printed fresh strength into late October, while the Conference Board's leading economic index fell again through August. One series celebrates, the other deteriorates. The result? Markets are pricing liquidity, not productivity. That divergence rarely lasts. Follow the money. Primary dealers, the banks required to bid at Treasury auctions, took down large chunks of duration. Buybacks recycle off-the-run bonds, yet supply still leans heavy. Auction tail, when demand is weak, shows up more when investors hesitate. Why it matters? Weak takedowns push yields up until buyers return. Look at employment. The official unemployment rate hovered around 4.33% into August and then rounded near 4.25% in October estimates. That's a small move. It is also a classic early sign. In 2007, half a point higher preceded the break. In 2000, the same. The pattern emerged again. Think of it like a crowded theatre. A few stand toward the exit. No one runs. Then someone yells, "Smoke!" That's the half-point rise. The stampede comes later. The constraint is simple. Fiscal deficit, when government spends more than it collects, remains large, so issuance can't slow much. Monetary policy, how the Fed sets interest rates and manages money, now loosens. When one foot presses the gas while the other rides the brake, heat builds in the transmission. That heat is interest cost. Now watch the plumbing. Real yields near 1.8% mean borrowing beats inflation after taxes for lenders. Corporate treasurers see that and hesitate. Boards delay buybacks. Investment spreads, the gap between corporate yields and treasuries, creep wider when growth dims. Translation: financing gets dear before revenues adjust. So far, policy eased, labour cooled, borrowing stayed costly. Coming up, when refinancing hits the wall. The mechanism works like this. Maturity wall. When lots of debt comes due at once, arrives between 2025 and 2027 for many issuers. Agencies refinance, municipalities refinance, corporations refinance. When rates sit higher on rollover day, cash flow thins everywhere at once. Picture a mortgage reset. The house didn't change. The payment did. Now apply that to thousands of balance sheets together. History shows a pattern. In 1989, the yield curve, the relationship between short and long rates, steepened after a long inversion. Recession followed. In 2007, funding looked calm in spring. By August, markets seized. Today, the curve steepened as cuts started and real yields held up. Different era, same stress lines. That's when things shift. Earnings guidance softens first. Hiring freezes next. Then layoffs. The market usually sees the first. The household data sees the last. The lag fools people. The numbers prove the fragility. Leading indicators slid by roughly 2 to 3% over 6 months into late summer. Unemployment revisions earlier this year erased hundreds of thousands of jobs retroactively. Consumer confidence flattened into October. None of these break alone. Together they grind. Think of erosion. One wave doesn't move the rock. A season of waves cuts a channel. Notice the gap. The Fed cut twice while inflation stayed above 2%. And Marty, that's a priority choice. It says employment risk outweighs price risk today. It also says financial conditions tightened more than policy wanted, even with a strong index tape. The math shows the hidden tightness. Positive real yields plus sticky spreads equals slow oxygen to growth. Follow the money again. Sovereign wealth funds, government investment pools, rotate when currencies wobble. Foreign official buyers step back when hedging costs bite. Then domestic banks, insurers and pensions must absorb supply. That pushes term premium higher. Translation: the Treasury pays more to keep the lights on. Now the pressure builds in energy and power. Data centers for artificial intelligence need electricity, land, and long-lead hardware. When utilities delay hookups or raise rates, capex, spending on big projects slows. The economy promised new productivity. The calendar delivered bottlenecks. That mismatch costs time and money. Here's what that means. The growth narrative leans on projects that arrive late and over budget. The financing clock does not pause. Watch the calendar. October 29th delivered a second cut. Mid-November brings large Treasury settlements. Early December brings another policy meeting. Each date piles into the same quarter. Markets often handle single shocks. Clusters cause accidents. So far, 2 cuts, steady supply, soft leading data. Next, where a quiet break could show first, the signal appeared in auctions. A few weak bids raised tails by a few basis points. That's small on paper. It's loud for desks that must place billions. The result? Dealers warehouse more risk. They demand higher concessions next time. That raises the government's cost again. Think about a grocery line. When cashiers slow, lines lengthen. A store adds a coupon to keep people waiting. The coupon is yield. Check this contradiction. Headline indexes perked after the first cut, yet long yields stayed elevated. If policy were easing into strength, long yields would usually fall. They didn't. The message is not party on. It's growth doubtful, supply heavy. The mechanism works through banks. Higher long yields compress securities values and capital cushions. Balance sheet runoff, when the Fed lets bonds mature without replacing them, removes a steady buyer. If deposits drift and loan demand softens, net interest margins shrink. Why it matters? Banks then lend less, which slows activity more. Follow the money into households. Pandemic savings thinned. Real wages just started to outrun prices again, but gains are narrow. Credit card balances climbed. Delinquencies rose from the floor. That does not break the system alone. It makes it brittle when a shock hits. Now the policy constraint shows. The Fed can cut, but not to zero while inflation runs above target. Treasury can issue, but not avoid refinancing the old stock. Congress can debate, but shutdowns disrupt data and planning. When critical data go dark, markets guess. Guesses widen ranges and raise risk premiums. Picture driving with fogged windows. The road didn't change. Visibility did, so speed must. The pattern emerged in late summer. Real yields rose while growth indicators rolled. Corporate capex plans slowed. Hiring cooled. Then the Fed cut. That order matters. In soft landings, cuts chase falling inflation with firm growth. In hard landings, cuts chase growth risk while prices resist. The second path hurts more. Now the pressure builds in 3 places. 1. Federal interest costs set a floor under deficits. 2. Corporate refinancing drags on buybacks and projects. 3. Households face higher service costs on revolving credit. Each pulls cash from future spending into past promises. The numbers prove the squeeze. Real 10-year rates hovered near 1.8% in early November. Treasury's quarterly refunding sized at roughly $125 billion in coupons. Auction concessions rose around weak demand days. Unemployment estimates rounded near 4 2/5%. None is crisis alone. Together they slow the machine. Translation: time got pricier. projects got slower. Buffers got thinner. So far, the setup resembles prior pre-recession windows. What changed this time? Watch the institutional psychology. The Fed cut with unanimity on the October implementation actions, while one September voter wanted a larger cut. That shows urgency. Treasury held coupon sizes steady for several quarters, but flagged future increases if needed. That shows caution. Markets rallied anyway. That shows hope. Check this contradiction. Hope trades like liquidity. Policy signals caution. The economy shows fatigue. When those three align, the calendar, not the narrative, decides the outcome. The mechanism works in slow motion. First, margins compress in rate-sensitive sectors. Housing adjacencies, transport, discretionary retail. Next, capital markets reprice. Fewer easy deals, more covenants, higher coupons. Then layoffs gather. The lag hides the trend until headlines arrive all at once. Think of a dam. Hairline cracks form long before the break. Water finds them quietly. History shows a pattern worth repeating. In 1998, easing into a tech boom fueled a final surge before a long unwind. In 2007, unemployment looked tame in May. By August, funding snapped. In both, investors mistook liquidity for strength. The rhyme today is clear. Now the calendar countdown begins. 60% in. Mid-November settlements test demand at higher yields. 80% in. Early December policy decision tests whether easing can continue with inflation above target. If a third cut appears, while long yields refuse to fall, the signal is stress, not comfort. The numbers prove the stakes. Each quarter-point cut reduces interest expense on floating rate debt. It doesn't change fixed-rate rollover that arrives next year. Leading indicators suggest growth slows into the first half of 2026. Treasury said steady for several quarters, hinting the heavy lifting remains ahead. The result? Relief at the margin, pressure at the core. Here's why that matters. The system is now sensitive to sequencing. If inflation reaccelerates while growth stays soft, policy loses room. If growth weakens faster, policy cuts more, but real yields can stay high if long inflation expectations don't fall. Both paths keep financing tight. Follow the money to potential release valves. A faster drop in real yields would help. Stronger foreign demand could help. A productivity surprise from delayed projects could help. None are guaranteed on the desired timeline. Institutions plan for the base case, not the best case. So far, rate cuts signaled growth fear, not victory. Supply stayed heavy. Data softened. Next, where first fractures likely appear. Watch regional banks. Securities marks and deposit costs still bite. Watch small cap credit. Spreads widen earliest there. Watch state and local budgets. Sales tax growth slows before income tax receipts. Each offers early tells. The constraint is simple. The United States entered this window with large debt, positive real yields, and policy tied between two goals. The usual toolkit still works, but each move now costs more elsewhere. That's the definition of limited slack. Think of a blanket that shrank in the wash. Cover the head, expose the feet. Cover the feet, expose the head. Check this contradiction one last time. Index strength says resilience. Labour drift says fatigue. Policy easing says concern. Treasury steadiness says no choice. The result? Calm data on the surface, pressure underneath. Now the final bridge. The system doesn't usually fail with a bang. It erodes. Auctions whisper it. Jobless prints hint it. Real yields confirm it. Then suddenly everyone hears the same whisper at once. That moment always looks obvious in hindsight. What happens next? If long yields fall with further cuts, relief spreads. If they don't, term premium keeps policy from biting. If labour holds near 4.5% and stops rising, soft landing lives. If it drifts higher and revisions turn negative, hiring freezes become layoffs. The math doesn't lie. Interest costs compete with priorities. Refinancing dates don't move. Positive real yields tax risky projects. Time carries a price again. The United States isn't unfixable. It is unprepared for a cycle that charges late fees on optimism. Follow the money in the months ahead. Watch November refunding results. Watch December policy language on balance sheet runoff. When the Fed lets bonds mature without replacing them. Watch real yields around 1.75% to 2%. Those three will call the turn before the commentators do. That's the setup. Small cracks became big breaks before. The signals showed early then. It is showing early now. Calm data, quiet stress. When the surface finally snaps, it won't be the first warning. It will be the last one anyone can ignore. Scoreboard before we close. Unemployment near 4.25%, and edging up. 2 Fed cuts in 6 weeks with real yields still high.